Did you know that hedge fund CEOs are 3 times more likely to develop addictions than executives in other industries? And here's the most disturbing detail. The industry not only allows it, it rewards Italiano. Today, we're going to delve into one of the most shocking stories on Wall Street. A story about how the pursuit of extraordinary returns can turn brilliant minds into walking time bombs. And in the end, you'll understand why the system was designed exactly to work this way. Get ready, because what you're about to discover in the next 40 minutes will completely change your perspective on the world of finance. Let's start with a number. 120 hours. This is the average weekly workload of a hedge fund CEO during periods of high market volatility. To put this into context, it means sleeping less than 4 hours a night, 7 days a week. But the problem isn't just the hours, it's what those hours mean. Every decision a hedge fund CEO makes can result in gains or losses of hundreds of millions of dollars. While you watch this video, managers around the world are monitoring positions that can make or break their careers in a matter of minutes. And here's the cruel paradox. The more successful you become in this world, the greater the pressure. Because now it's not just billions of dollars at stake, it's your reputation built over decades. The system works like this. You start as an analyst, working 16 hours a day, analyzing companies. If you survive, you become a portfolio manager. If you're lucky and talented, you eventually open your own fund. And that's when the real pressure begins. Because now you no longer answer to just one boss. You answer to institutional investors who can withdraw hundreds of millions from your fund with a simple phone call. You answer to pension funds that entrust the retirements of thousands of people to your decisions. You answer to your own ego, which led you to this point. Let me tell you about James. That's not his real name, but the details of the story are true. James founded his hedge fund in 2005, at just 32 years old. He was considered a prodigy, a mathematics graduate from Princeton, with an MBA from Wharton. He had worked at Goldman Sachs and achieved returns of 40% per year for 3 consecutive years. When he launched his own fund, he raised $200 million in the first year. Impressive for a new fund. His initial investors were primarily university endowments and family offices, the kind of smart capital that all fund managers want. The first 3 years were spectacular. James delivered consistent returns of 30 to 40%. Well above the market average. His fund grew to $1.5 billion. He was on the cover of Institutional Investor. Won awards. He was invited to speak at conferences around the world. But something was happening behind the scenes. To maintain those returns, James had developed an increasingly aggressive strategy. He used leverage, basically. He borrowed money to amplify his positions. If the market moved in his favor, the gains were multiplied. But if it moved against him, the losses were also multiplied. And there was another factor. James practically didn't sleep. He monitored Asian markets in the early morning, European markets in the morning, and American markets during the day. His employees reported that he often spent the entire night at the office. He started taking Adderall to stay focused. Then came Modafinil. After that, he ordered customized combinations of nootropics from specialty pharmacies. His wife left him in 2009. He lost custody of his 2 children because he was simply never there. But James said it was worth it. He was building something bigger. To understand what happened to James, we need to understand the unique pressure structure that exists in hedge funds. First, the performance fee. Hedge funds typically charge the famous 2 and 20, a 2% management fee and 20% of the profits. This means the manager only earns real money when the fund performs well. That seems fair, right? The problem is that it creates a perverse incentive. If you're underperforming, the only way to recover is to take on greater risks. Because if the fund collapses, you can simply start another one. But if you have an extraordinary year, you can secure compensation of tens or hundreds of millions. This is what they call asymmetric optionality. You have an asymmetric incentive to take risks. Second, the redemption cycle. Hedge fund investors can generally withdraw their money with 30 to 90 days notice. This means that 3 consecutive bad months can result in a bank run, where everyone wants to get out at the same time. Imagine driving a Formula One car knowing that if you slow down, your sponsors will abandon you immediately. But if you accelerate too much, you could crash and ruin everything. Third, constant comparison. Every month, funds publish their returns. Banks and consultancies create rankings. You're not just competing against the market, you're competing against 5,000 other funds, all trying to prove they're better. And here's the crucial detail. The top performers receive disproportionate attention. The number 1 fund of the year receives hundreds of millions in new investments. The number 50 fund might go out of business. Fourth, the problem of talent drain. The best analysts and traders want to work for the most successful funds. So, if your performance drops, you not only lose investors, you lose your team as well. James was experiencing all of this simultaneously. In 2010, he had his first negative year, only -5%. But in an environment where he had promised returns of 30%, it was devastating. Investors began to question whether the magic was gone. He doubled the position. 2011 began with James determined to regain investor confidence. He increased the fund's leverage from 3-to-1 to 5-to-1. This meant that every dollar an investor held controlled $5 in positions. In the first quarter, it worked. The fund rose 22%. Articles began circulating. James' triumphant return. New investors appeared. The fund grew to $2 billion. But James was now completely dependent on stimulants. He was taking Adderall at 6 in the morning, another dose at noon, and often a third dose at night if the Asian markets were volatile. To sleep, I used Ambien. For the anxiety that came from combining drugs, I started with occasional Xanax. Then, daily. His personal physician, one who treated several Wall Street executives, prescribed everything without asking difficult questions. After all, James was paying $100,000 a year in consultations and was functioning. Functioning is a relative term. Fund employees began noticing erratic behavior. James would explode in meetings. I'd have grand ideas at 3 in the morning and wake the entire team up to implement them. Then I'd completely forget about them the next day. There was an incident at a conference where he aggressively confronted a competing manager, accusing him of copying his strategies. Security had to intervene, but the returns kept coming. And in the world of hedge funds, returns cover a multitude of sins. Until August 2011 arrived. Do you remember? The European debt crisis was intensifying. The United States lost its AAA rating for the first time in history. The market panicked. James was positioned incorrectly. Very incorrectly. His leveraged positions in European banks, which he believed were undervalued, plummeted. In 3 weeks, the fund lost 38%. With leverage of 5-to-1, this meant that the investor's original capital had fallen by more than 70%. The phones in the office started ringing. Investors wanted answers. They wanted to know if they should withdraw their funds. The spiral of redemption began. And James had a nervous breakdown. It was a junior analyst who found James in the office bathroom at 4 in the morning on a Tuesday. He was sitting on the floor, trembling, unable to form coherent sentences. He had vomited. He was having visual hallucinations, a known side effect of combining multiple stimulants with anti-anxiety medications without adequate sleep for days. The ambulance arrived discreetly through the service entrance. The hospital listed the admission as acute stress and exhaustion. The truth was more complex. Unintentional overdose, combined with sleep deprivation-induced psychosis. James spent 3 weeks in the hospital. When he was released, his fund had lost 80% of its assets under management. Investors had withdrawn everything they could. Those who remained were trapped in illiquid positions that would take years to unwind. The fund's board voted to close it. James agreed without resistance. But here's what most people don't know. James's story isn't unique. It's frighteningly common. A 2015 study published in the Journal of Financial Economics examined the mortality rates of hedge fund managers. It found that they die, on average, 5 years earlier than executives in other industries. The main causes: heart disease, stroke, and suicide. Another study, this one from Harvard, interviewed 200 fund managers anonymously. 68% reported using some type of performance-enhancing substance, whether prescription stimulants, unregulated nootropics, or illicit drugs. 42% met clinical criteria for anxiety disorder. 28% met criteria for depression. And most didn't seek treatment because, in the words of one interviewee, "If my investors found out I was taking antidepressants, they'd consider me weak. The money would disappear in a week." So why does the industry allow this? Why aren't there more protections? The answer is unsettling. Because it works, or at least, it works for the right people. Look, hedge funds aren't charities. They're money-making machines designed to extract the maximum possible return from the market. And, cyclically, that requires people willing to sacrifice everything. The funds that survive the Bridgewaters, the Citadels, the Millenniums of the world have developed systems to institutionalize the process. They don't rely on a single genius working 120 hours a week. They have teams, processes, technology. But most funds don't get there. Most are run by brilliant individuals who believe their superior intelligence and tireless work will take them to the top. And the market encourages them to think that way. Because occasionally, one of them succeeds. James, in his early years, delivers extraordinary returns, and that keeps the dream alive for 1,000 other aspirants. It's brutal natural selection. 90% of hedge funds close within 5 years. The managers who survive are, by definition, those willing to go further. Takamore risks sacrifice more. There's even a term in the industry: eating your own cooking. It means that managers invest their own assets in the fund. The idea is to align incentives. If the manager loses money, they lose theirs too. But what this really does is increase the psychological pressure exponentially. Now, it's not just the career at stake. It's not just the investor's money. It's the house, the children's education, the family's future. James had 80% of his net worth in the fund when it collapsed. He lost $40 million of personal wealth in 3 weeks. And yet, when you talk to active managers, most will tell you they would do it all again. Because the good years, those years where everything clicks, where you're ahead of the market, where returns flow, are addictive in a way that no drug can replicate. It's the feeling of being right when the whole world is wrong. It's seeing your analyses translate into extraordinary profits. It's the public validation, the awards, the respect of the industry. A former manager described it this way: it's like surfing the perfect wave. You know, you're eventually going to fall, that the wave is going to break, but while you're on top of it, it's the best feeling in the world. And you'd spend the rest of your life trying to find that wave again. So, what is being done about it? Honestly, not really. Some larger funds have implemented wellness programs. They have psychologists on staff. They offer meditation, yoga, and state-of-the-art gyms in their offices. But it's like putting a band-aid on a hemorrhagic artery. The problem isn't a lack of yoga. It's the fundamental structure of how the industry operates. There are occasional regulatory proposals. The SEC has discussed stricter leverage limits, increased transparency requirements, and restrictions on fee structures. But the industry fights every proposal with intense lobbying, and it has a compelling argument. Hedge funds are for sophisticated investors. If billionaires and pension funds want to take these risks, who is the government to stop them? Some managers who have experienced similar breakdowns to James have become advocates for change. They speak openly about mental health, the dangers of an extreme work culture, and the need for better support systems. But they are often marginalized, seen as weak, as those who couldn't handle the pressure. There is a small but growing movement of sustainable funds, managers who deliberately limit their size, prioritize risk-adjusted returns over absolute returns, and implement healthier work cultures. Some are succeeding, proving that it's possible to achieve excellent performance without destroying lives in the process. But they are the exception, not the rule. The inconvenient truth is that, as long as the market rewards extreme behavior with extraordinary returns, managers will continue to take those risks. Because the alternative, mediocrity, irrelevance, is unacceptable to the type of personality drawn to that world. James is 51 years old today. He no longer manages money. After his fund closed, he spent 2 years in intensive recovery. Treatment for stimulant addiction, therapy to process the trauma, rebuilding relationships with his children. He lost most of his assets, but not all of them. He had to sell his house in the Hamptons and his apartment in Manhattan. He moved to a quiet suburb in Connecticut. Today, he works as a consultant. He helps family offices evaluate investments in hedge funds, and he uses his story as a warning. In private conversations, he admits, "I knew I was destroying myself." We all knew. But at the time, it seemed to be the necessary price for greatness, and the entire industry validated that belief. The scariest thing, he continues, is that I still miss it. I would wake up at 4 in the morning with my heart racing, check the Asian markets, feel that adrenaline rush of seeing a position moving in my favor. It was destructive, it was unsustainable, but it was intense in a way that nothing else in life can replicate. And I see young managers today making the exact same choices I made, working the same insane hours, taking the same substances, making the same rationalizations, and there's nothing I can say that will stop them, because right now, they don't believe it will happen to them. They believe they are different, smarter, stronger. I believed that too. So, does the CEO position at a hedge fund encourage self-destruction? The honest answer is yes, not intentionally, not explicitly, but through the incentive structure, the culture, the expectations. It's a system designed to extract maximum performance, and often the cost is human. Does this mean all managers will collapse? No. Some develop healthy coping mechanisms. Some have exceptional support systems. Some are simply lucky, but the casualty rate is high enough to be concerning, high enough to question whether the returns are worth the cost. The question is not whether hedge funds should exist. It is whether we can create structures that allow for excellence without requiring self-destruction. And so far, the industry hasn't found the answer. Meanwhile, a new generation of Jameses is starting their careers. Brilliant, ambitious, convinced that they will be different. History suggests that many will not be, and perhaps that's the most important lesson. In a system where extraordinary success demands extraordinary sacrifice, we need to be honest about what we're asking of people, because the true cost of 40% annual returns can be much higher than any performance fee. Thank you for watching. If this story impacted you, please share it. The more we talk about it, the greater the chance of real change.